I hear you, Mark.
Hi there, Dale.
How are you, buddy? So
I'm fine.
great to have you with all the action happening here. To share your screen, buddy, you just hover your mouse over the menu. You'll see a green box that says share.
Let's see one second.
Okay. Like over the menu, it's probably in.
Let's see, there's view options.
No, it's you'll see like a Q&A box. You have the whole menu. It's like a drop-down menu, and it'll be a green box that says share, and you just click that. See it? If you just move your mouse around, you'll see participant. There we go. Okay, we're good.
All
buddy.
good. Yeah, how are you? How's everybody? Thank you for joining today. Can you hear me okay?
Yeah, can hear you. If you want to use your webcam, that's fine too. That's me. So, all right, Mark. Was yesterday a critical day in the S&Ps, taking out 2975. I'm curious where your head's at now.
You know, I think near term it was an important and a bearish development. You know, we'd held in this area of range-bound consolidation for the market for the last 9 trading days, which was interesting because a lot of the sectors and really bond yields had peaked out right around mid-month, around the 13th. And so, you know, it was a question to me and to many that, you know, whether the market could absorb all this sector rotation out of, you know, sectors like transportation or what was happening with technology, discretionary, industrials, financials. All of these had started to head actually lower right around mid-month, but yet markets had held up. And so I think yesterday's break was really the first sign that the indices themselves were likely going to have at least a minor pullback. So, you know, near term,
well, you know the difference. You never know. You never know until you look back, do you?
Yeah. Well, there are a couple things in that. It's proper to start, I guess, from a longer term perspective, but just to look at what's happening with the short term pattern, this is really going to, at least for me, give me a lot of indication as to whether this could be a lot more serious. It's just when you look at the prior area of the breakout, right near this 2940, 2950. I mean, structurally, that's a really big deal. You know, we consolidated, obviously, the area right near August highs, and we hit that in the latter part of August. So
it measured 3100, didn't get there. That formation.
Yeah, I'm not thinking that that's necessarily off the table. I think that is a possibility, but obviously the next 3 to 5 days I think are going to be lower. So tactically, I think it's right to be a little bearish, and I'm expecting potentially that we try to hold there into end of month, and that actually we could actually start to rally into October, and we'll see if we get to my target's right near 3050 to 3075.
Like the top of the megaphone.
Yeah, there's a lot of things that can be projected up there based on Gann, based on Fibonacci, and so that's just an area that stands out to me. And you know, we rallied up to prior July highs and stalled out there with regards not only to the S&P but many different sectors, and I think that at that level has really got to be broken. But you know, when you talk broader markets, I mean, you know, sentiment is still pretty skeptical across the board. We've seen a little bit of improvement, so it's more neutral now, I guess, than it was a month ago. Last month we had real fear, and now it's improved, and so that's certainly, you know, I guess to some extent constructive. I think a lot of the things that people were worried about have been alleviated, but now, of course, with the possible impeachment process and the indecision there, we went from one thing to the other. There continues to be things that worry this market, whether it be...
Does U.S. dollar yuan bother you? That it may not have peaked out here? I mean, I watch the yuan as a trade war barometer.
Well, I think the longer-term pattern in that it was actually very bullish. I mean, obviously, there's a certain amount of... there's only a certain amount that it can float freely, right? But to get up above 7 from a dollar perspective versus yuan is certainly that's a very good pattern, and so that suggests to me like we could see further yuan deterioration, see further movement in
Yeah.
And the dollar higher. So
you have impeachment, trade wars. I was reading things that someone who supports Trump, he's an economist, my buddy Jim Walsh put it out, that tariffs before they're done could go to 100%.
yeah, it's anybody's guess. It's tough when you don't really know. I think that we'll look back and see that that was really probably the catalyst that caused the recession. Potentially a couple of years from now, we'll look back and say, that, and only because I think people have gotten very cautious, and you're seeing some pretty massive pullbacks and with regards to just how companies and individuals make decisions in this environment. And I think that's going to be a larger thing. I think that globally, there's a lot of evidence of slowing. You can't really see that yet in the US. So if anything, the Fed was faced with a really interesting dilemma, only because our own economy in the US had actually been showing fairly good evidence of strengthening really since June. The data had been very, very strong. And so I look at like the City Economic Index, and you see just patterns of that. Let me see if I can pull that up real quick. And so, that was actually this is a very, very big move off the lows. This for those that are
business or consumer, Mark?
I'm sorry?
This index reflects business or the
just economic data performs versus expectations just for the year.
Okay.
So this actually shows that as of the latter part of 2017, that most of last year was negative. Data was getting worse, and then actually started to improve pretty dramatically. And so heading into the Fed meeting, a lot of data was beating expectations, and the market was sort of running on all cylinders. That's why, in my opinion, there was a lot of dissension as to what the Fed should do. People say, well, wages are growing, inflation's growing, unemployment's low. Why are we cutting if the Fed truly is going to stick to their original mandates, unless they're really paying too much attention to, the global economy and making a proactive cut, or whether they're doing it because of Trump, or, you want to maintain independence. And so,
do you think that Rod,
but go ahead.
Do you think that Rod Serling could have written a financial episode that we're living through now, bro?
Yeah, it's really a very surreal time in a lot of respects. There's a lot of still a lot of frustration and anger, and politically. And now we're entering the election time, and that's going to be really interesting in how that shapes up. And so, my bottom line thinking is that equities likely are going to be positive into next spring, and then we probably for the first time can have a larger peak to this entire bull market. I think we've seen a flattening out, but I don't think we've seen, a lot of people say we're in a bear market, and you could say that potentially about Europe. You look at like the stocks 50 that have been trading sideways for.
We're the last to cave.
But for the S&P, the highest momentum readings we saw in the last decade were really last January. And so, yes, the market's been flat. That's really the best way you can put it. We've obviously had a healthy rally off last December's lows. But, you look at charts of like the stocks 50.
So is it accumulation or distribution, this flatness?
You know what? I mean, a lot of the cycles that I look at suggest that 2020 into 2022 should be negative, and that I think that what we've seen in the S&P was really the first shot across the bow starting last January with regards to momentum hitting very, very. Let me see if I can pull a couple indicators up here to show you what I'm talking about. So, what's interesting is that you have things like MACD, RSI, those hit very high levels, and we've seen a lot of divergence on a monthly basis since last January. And to me, that's a little bit of a concern. Markets have pushed higher. You can see that the highest point in momentum on a monthly basis was last January. We hit an RSI, 14-period RSI hit nearly a 90. Yeah. We haven't seen that in a long time. We sold off. Markets have pushed higher. This has been lower and lower and lower. RSI is this first momentum, and then the second one, of course, is MACD, which has tried to turn positive, but yet we're well below,
glaring non-confirmations.
So that doesn't mean that it's bearish. It just means that we're flattening out. But I tend to think that a lot of this negativity is going to come to roost probably next spring, and if anything, that would be the first time that we could see at least some evidence of us peaking out. But the markets are still very strong. We haven't seen hardly any.
Yeah.
For sentiment to be neutral to negative, and we're right near all-time highs. I mean,
Great point.
That's
Yeah.
crazy. I mean, really, the markets have been. So I'm looking at really two things. I'm looking at financials.
Dale.
And I'm looking at
Yes.
technology. The one thing I would mention to you. Go ahead.
We just sorry to interrupt. We have a question which is relevant from a friend, Ben. What is your viewpoint for the VIX as well? Because you mentioned divergences, but we also see glaring divergences in the VIX, right?
Good point. New highs in the market, higher lows in VIX.
Yeah, that's a very long-term thing. The VIX is, I mean, that obviously. So yeah, here's the VIX. We seem to be coiling. I mean, volatility is understandably.
It's really
low.
my EKG, Mark.
It's understandably low because we haven't seen any volatility. I mean, it's been. It's tough to look at it and it's low, and you say, well, it should be higher because of all these measures, and people are. That's it sounds correct, but the bottom line is until you see the equity weakness, the VIX should be low, and there shouldn't be any real.
Yeah, of course, but I mean, we do have higher lows. VIX is suppressed, there's no question about it, but look at the glaring divergence since the period that we were trading at single digits or almost daily to what has happened since, right?
Yeah, so from a technician, do I really want to buy this here? Maybe short term, I can see the movement in the last week could lead us a little bit higher, and I am long a little implied volatility here that I plan to exit in the short run. But my thinking is if you see the VIX up near 21, and then likely we could very easily compress and pull back over the next month. I'm not certain that. We'll see if October turns out to be down or not. I mean, a lot of it's going to depend on, do the indices show any material break? And if they do, then it's proper to respect that. I think obviously S&P getting under 2940 takes us down quickly to 2875 area. And
yeah, I think under 2940 seals it for it to take out the early June low.
So yeah, the swing low from August 28-22, that can't be broken without causing a very material break. And so, until that happens, I'm going to be very tactical, short-term oriented, and yes, near-term I am negative. I think that pullbacks over the next few days, it's more of a wait and see. I'm looking at a couple things. One is technology, and tech really has to, for the bulls, it needs to really hold. When you look at indices like XLK, that's not necessarily a great stalling out. And so if you start to really weaken, tech is 22% of the market. That could be a lot bigger deal. But, advanced decline is at all-time highs. I mean, you pull back over 2 weeks, but I mean,
there are a lot of conflicting signals.
In history when the market has had a serious pullback and gone into a bear market when advanced decline was at new highs. One was, I think, it was May of 1946. The other was 1956. In March, we peaked out. I think advanced decline had only made a 1 month divergence. And then the last time was 76, where there was zero divergence. Then we began a bear market to 78. But generally, you see a very good lag. This is a leading indicator of breadth. Breadth tends to turn down pretty sharply ahead of lengthy bear markets. And we just haven't seen that. And so I see us as the indices are in very good intermediate shape, even though we have seen a waning in momentum, and that's important. However, you haven't seen any material damage, and sentiment is pretty negative. And, this is a year ending in 9. It tends to be a very good year. And yes, there are some cyclical factors. And for those that study astro, there's some things that coming into play next year that are, historically have been very, very, they've caused a lot of energy, to say the least, right? And so we're ending a period now where I think we're exiting a lot of the positive factors and heading into a more negative time.
But you could go broke in the meantime, playing that out.
Do I really want to be out of the market 100%? Well, maybe if I have a 3-year time horizon, sure. But we haven't seen that technical weakness. So it's tough for me to be intermediate term bearish when advanced declines at new highs, sentiment's negative, seasonality arguably we do have a period of bear seasonality coming up in October. In pre-election years, it tends to be very negative. The latter part of September is almost a 65% downtime between the 16th and the end of the month. So heading into the end of Q3 is understandably negative. October is also not great for pre-election years. After that, I mean, I could argue that markets probably can attempt to rally into the spring, and that's when I think you see the real divergence. I think advanced decline starts to turn down. Markets attempt to push up, but maybe tech doesn't lead. Maybe you see a switch into healthcare, and that would be sort of interesting to me to see. That's the first time that other things start to pick up the slack, but yet we don't really see any real push that breadth really falls out of favor. And,
where are you at on yields, Mark, and the dollar?
The dollar is making a pretty big move today. I'll start with that, only because
Okay.
you're seeing pretty good deterioration in pound sterling and in euro. And I think with regards to the Bloomberg Dollar Index, which I look at, I'm a little constructive on the dollar in the short run, meaning the next probably 2 or 3 weeks. But generally the time from June has been pretty positive. We saw a very mild consolidation here. I think today's move likely is going to lead us higher in US dollar, which means that commodities might wither. You might see EM underperformance. If
Metals, correct.
they're pulling back, and so I don't know. Precious metals have been historically pretty strong in October, and I'm not willing to fade that trade yet. But I do think near term the dollar can rise. I've been thinking the dollar should start a peaking process. I don't know that we've seen enough to make that call yet. So
maybe in the spring with your S&P call?
Yeah, I wish I were smart enough to say it's exactly when the dollar peaks. I tend to take more of a tactical view only because that's what people appreciate. If I make these grandiose long-term calls and
Oh, Nostranewtons.
I think, the dollar tends to work in this longer-term 8-year cycle, similar as to euro and sterling. And I do believe that we probably peaked out in 2016. And so I do think the trend likely is going to be lower into the early 2022, to 24 area for the dollar. However, near term it acts pretty well. When you take a look at any of the charts, DXY, Bloomberg Dollar Index. So most of the DeMark signals on like the euro and sterling are still a little premature to think that lows are in place. So I'm a little. Between now and year end, I could take a positive stance on the dollar. That's about as far out as I want to go and say, you know what, I do think that you have a bit more strength, and the DXY gets up and probably challenges 102. That would give you monthly counter trend sells based on DeMark for the first time, based on sequential since for quite some time. So you'll have combo and sequential counter trend sells if we rally back up and really get above 102, which is a big move from 98. So, yeah, I don't know. I think
that's a great look and excellent analysis. Kind of clears some things up for me, Mark. How about this bounce we had in yields? Is that are we going to new lows in yields, and that was just a temporary bounce? And what's your longer term outlook into what most of the money has moved into, probably the much more crowded trade than long equities, with how money has shifted the last year and a half out of equities into bonds? What's your take on them here?
Yeah, here's a long-term trend of just 10-year treasury yields going back since the 90s. And if you extend it back to the 80s, I mean, it's similar, but this is really the more realistic longer-term channel. And, I thought that potentially we were attempting to break out of that late last year, but that just proved very short-lived. We didn't make any progress. And of course, the move in December sort of sealed the deal as to saying that was definitely a false breakout. And so, yeah, trends are down. We got down near former lows.
30-year took out that low, 10-year hasn't yet. Yeah.
So I would say, in general, I am, I'm thinking that we pull back and at least test these lows at 142 and probably get down to the mid 130s. However, given the recent positive correlation between equities and treasury yields, at least, it's interesting because yields have gone straight down, equities went nowhere, now all of a sudden equities are following suit. It's always tough, but trends are certainly still very negative for yields. You have started to see some evidence based on this bounce that we saw into September of some momentum was improving a little bit. So on any pullback at this point, you're likely going to see some divergences, and that could create a, at least a short-term bottom for yields. But I think you probably pull back and test, if not get below that. And, the areas in 2016 were near 132. So, I'm still favoring being long treasuries, TLT, and think in the short run that we have, we can probably pull back and test that. I look at a combination of cycles and DeMark and just momentum, and I just don't see enough right now to think that that it's right to be all that negative on treasuries. I think if anything, in the next 3 to 5 days, you pull back and test 146 into next week. That sounds like a severe move, but if we get DeMark type buy setups and yield right near former lows and momentum's a lot higher, I could make a case for taking a stand and trying to short, trying to sell treasuries at that point on any further strength into early next week.
Okay, Mark, I think we covered the gamut like we usually do. And anything you want to wrap it with?
I just, in general, I think it's right to pay attention to sentiment. That tends to be one of the more important things. It's even more important than news in terms of being a catalyst for longer term, intermediate term movement in the market. I think people pay such attention to the tariffs and everything else. And when you look back, a lot of this has been ongoing, and equities have been actually in pretty good shape since last December, and it really has not affected things, even though we all look at these short-term swings and, the algo type movement intraday. But bottom line is that, there's still a healthy level of pessimism, and until that changes and or we see material deterioration in stock trends, then I think it's going to be a time when you still have to, to buy dips for those that look at the market every day. And for those that are wary, we need to see a move down under monthly lows. And if that happens, that will certainly change my tune. So if I don't get the chance to speak again, if we undercut August lows, then I think, the bear market certainly has begun. I think that, and certainly under June lows, but I'm just not expecting that, right away. The one thing, it's interesting that, and I'll end with this, is that Samuel Benner ran a very famous cycle on pig iron prices way back when, and this year is a panic year according to his cycle. He tends to alternate the 16, 18, 20-year cycle, and for those that want to study those cycles, it does come up as this year, but in the past, it's just been important to monitor that. So.
Okay, a panic cycle in pig iron?
Well, he started doing pig iron, but he applied that to really everything.
Okay.
In terms of just looking at that numerical system for assets. And so,
all right. Wow.
That's something to, I can post some things on Twitter about that, but I don't want to say that we're going to panic, because I tend to be I'm more of a dip buyer here, and until I see things change, I don't want to spread a lot of doom and gloom. But yes, this year is,
What a great overview, Mark. You helped me. You helped me with some of the things I was considering, so I know you helped everyone that was here listening to you live and will listen to the interview. Why don't you show your website so people know how to stay in touch with your work?
Yeah, so I'm on Twitter and LinkedIn. You can certainly find me there. I do run a consultancy-based business, a web-based subscription business. I provide technical analysis to institutions and to individuals, and so you can reach me at newtonadvisor.com. I do provide a daily and weekly notes. I do a weekly conference call, and I do a video literally every day that discusses what's happening in the market. So I'll be on CNBC tentatively today at both 2:25 and also in Fast Money at 5:20 if they don't, if nothing
great.
comes up. So
well, I'll turn the volume up.
Perfect.
All right, buddies. All right, and I hope you have a great fall trading season for you and your clients, Mark.
Likewise. Thanks very much, Dale. It's great joining you guys as always. Have a nice.
All right, my trading warrior brother. Adios.
Take care.
Okay, everyone, that's a wrap for us, and see you in the private members chat. Remember, don't just count your pips, count your blessings, and see everyone tomorrow. Thank you, Mark Newton.